most explorers would like to find something, irrespective of what commodity it is, because you generate value by doing that.
One of the solutions for the smaller companies, perhaps, is who don't have the big programs, is to be really nimble and be ready. Have your projects permitted, drill ready, have your people ready.
But on the positive side, discoveries have been coming. I mean, that inflow of money into the sector, which has been, I guess, starved for exploration. We've been seeing some terrific discoveries in Australia and globally, and as a direct result of that. And that fires up investors and people looking at the sector.
Introduction, I would like to welcome everyone to the Assay Live webinar focused on Australian exploration. So with us today, we have John Forwood, Chief Investment Officer at Lowell Resources Funds, Richard Taylor, Executive Director and CEO at Sansor, and Hedley Widdup, Executive Director at Lion Selection Group. So thank you everyone for joining us today.
Thank you for having us, Amy.
Thanks.
And so, across the commodity spectrum, we've seen analysts predicting a significant shortage of supply in the coming years. And so in line with the growing trend to nationalize commodity supply chains, Australia is seen to be doubling down on its domestic exploration to grow national reserves and to help ensure an adequate supply to help meet the growing demand for metals and minerals. We saw a huge budget increase for Australian exploration in 2021, and it does seem to be continuing on. So I thought we could just start by setting the scene. What are some of the trends that our panelists have seen over the past year? So maybe Hedley, if you'd like to kick us off there.
Yeah, sure. Well, I think when you're talking about explorers, you can point to two things which really stand out in 2021 versus many of the years in the lead up to it. First one is how much money they've been able to spend. And if you exclude a lot of the majors, but they are behaving in a very similar way, there's been an awful lot of money spent in exploration and in earlier stage ventures in 2021, there's a lot of work done. It means there's a lot of ounces, tons of metal, etc., have been added to inventories and discoveries made, and that perpetuates the interest in it. But the flip side of that is that to be able to spend that money, a vast majority of the companies who are spending it have had to raise it, and I think we've seen very, very close to record metrics in many markets for fundraising for early stage endeavours. It's difficult to get the absolute granularity, but Rob Murdoch from Austex, I was talking to the other day, and he's published figures for 5B raisings in Australia, which covers the pre-production mineral resources space companies, raised, I think it was $9 billion during 2021. Now, if you contrast that to earlier years, typically a good quarter in Australia was somewhere between $500 million and $1 billion raised by the same group. This was 9.6 over the whole year. So it's an enormous jump. And I think that probably stands on record as being the highest year for a very long time, if not ever. The TSXV in Canada, which is the junior exchange there, just raised over $6 billion for the first time as far back as the records go for a similar junior group of companies. So, I mean, this is money flowing in and activity is absolutely booming there.
Yeah, I think that's right, Hedley. We've seen, and the money's starting to, last quarter, I think Rob Murdoch's data showed about $3 billion raised on ASX for that mainly exploration group of company. And there was about, I think, 900 million that went into the ground in that quarter. So, that's, they're sort of spending it, they're raising it at a really nice clip, but the companies are also spending it, pretty quickly as well. If that's sort of the metric, then that money will be spent in about 3 or 4 quarters. But I guess the other trend that we'll come to is the cost of exploration and the ability to do exploration, and the costs have gone up and the pace has slowed down. It's not just a question of ringing up your favorite driller mate and saying, "Oh, can you get the rig to me on Monday?" It's extremely hard to find, well, not so much a drilling rig, but more a competent driller. They're the guys that are really in demand. And I think that probably goes across the exploration sector. It's drillers, it's geologists. You know, I want to go back and be a first-year exploration geologist again, because the amount some of those guys apparently are getting paid up in the Pilbara is amazing. You know, but yeah, you know, the mining industry or the exploration industry has got a finite number of people in it. There's not a lot of new joiners, I have to say, in terms of, you know, say the amount that Australian unis are pumping out in terms of geoscientists. You know, when there's money to be spent, you know, it's getting spent on, you know, there's not that many people for it to go to. So we're seeing costs rise quite significantly. Richard, I don't know if you've got the boots on the ground. I don't know if you're seeing that.
Completely. I was just going to pick up on that point and just give you a flavour of what we're seeing. I mean, we, in one of the cases, looking for a drill rig, a specific drill rig, no availability for more than 12 months because of major drilling programs by the top tier firms. At the moment, there are rigs available in WA, but there's no one available who can get in to actually be able to crew those. They're working single shifts. So you're looking at delays in being able to plan drilling programs, but close to 3 months or up to 3 months in assay turnarounds. So you're required to book a rig before you've got the results from your last drilling program. Costs, availability of labour, you're looking at a sub 3% unemployment rate pretty soon, particularly in WA. All of that is creating cost pressures. You're looking at requiring, I guess, bonus payments for drillers to accept small jobs. And it's really the small end of town that are being squeezed by some of the majors who are undertaking for the first time, in some cases, major greenfield exploration plays. You're seeing, I guess, companies, particularly in the nickel and copper space, just starved of assets that they can look at picking up that are close to development or production. They're moving back into greenfield exploration where sometimes they haven't been there for decades. And you've got a lot of cashed up juniors, 120 plus mining IPOs on the ASX alone just last year, who don't have the, I guess, the internal skills to be able to develop targets and be able to monetize the assets and exploration tenements there. So there's some great opportunity. We've raised a lot of money. Actually getting out there on the ground and deploying it now and delivering against what we said is the real challenge.
Historically, and this question goes to both of you, I have some thoughts of my own, is historically when money floods into the sector, it causes inflation, and the shortage of drill rigs or shortage of skills is not something which is a new flavour, but I do sense that it's been quite significantly in this case impinged by COVID and the ability to import labour from overseas, or even to get it across borders in Australia. So I don't know if you have a feeling for how much that is a recent impingement. I mean, one example, just for example, and this is an operating example, not an exploration one, but I think it costs Oz Minerals somewhere between $80 and $100 million a quarter to run its operations. If you just go back through their last few quarterlies, their most recent quarterly, December 21, it cost them, I think, in excess of 115 million. So it's a jump from somewhere between 80 and 100 to 115. Now that encompasses a great many things. And the comments which were made seem to stem from you generate inefficiencies by people calling in sick. There's more and more people calling in sick, and some which are isolating because of exposure. And that generates more cost to either fill their position or you have a damaged efficiency because of it. And I expect that in exploration, that actually has a far bigger effect, because you don't have a crew of 20 people who can fill a gap of one or two. You have a crew of 2 or 3 people who can't do without one of them. And if one of them goes down, then they probably all do. So, Richard, perhaps, this just seems to me that it could become something that becomes a big issue for companies to be able to generate news flow and interest investors in a very short period of time.
Yeah, I think the majors and junior explorers, they're doing a really good job, particularly in WA, at managing the COVID impact. It's really the effect of closed borders, both internally in Australia and internationally. I mean, the real place that we see the squeeze is around unskilled labour. So while I guess the international opportunities for skilled migration have reopened, the industry has relied on unskilled labour to be able to crew the drill rigs in those locations, and they haven't been available. So same things we're having with fruit picking and other areas which have been supplied by our regional partners and labour we've been able to bring in internationally. Our operations are being shut down because of unavailability of the offsiders as opposed to the skilled labour that's running those rigs. The other one is getting talent. We're quite lucky because we have Perth-based or capital-based roles. But getting those key geologists into field-based positions, that the graduates, which John was talking about before, the numbers and the starting salaries are something we haven't seen since the pre-GFC days, and that was only for a very short period of time. But this is sustained, ongoing price inflation for both skilled and unskilled labour if you can get it.
Yeah, I've been telling my uni student kids that they should go and get a job in a sample prep lab, because I think that the wages would be pretty nice. But we don't want to harp on about it. But I was talking to Andy Tudor from Nexus Minerals the other day, and he says he's got the 4th biggest drilling program in Australia this year. I think he's hoping to get 300,000 meters drilled. He said he had 4 British geos ready to land in Perth on I think it was the 6th or 7th of February. And then Mark McGowan changed the rules, and they couldn't arrive. So that's just a one small example of how hard it is to get skilled or unskilled labour into a really hot economy.
We haven't yet seen this sort of bite on investor interest. I mean, it's hard to blame a company for their ability to access geologists in a starved market or to deliver assays when there's a 3-month wait. But sooner or later that becomes an issue, particularly if pulses sort of start to slow a bit, and disinterest can creep in there pretty quickly. I haven't seen an indication of that at the moment, but John, you probably speak to a lot more explorers on a far more frequent basis than me. I don't know if you have any observations there.
Yeah, look, I think certainly investors really want to see, okay, I'm going to put my money in today. I want to see that the drill rigs are turning tomorrow or next week or very soon. And I think it's tough for if companies want to try and raise funds and then say, well, okay, we won't be drilling until middle of the year or something. That just turns investors off. But I think one of the solutions for the smaller companies perhaps is who don't have the big programs is to be really nimble and be ready. Have your projects permitted, drill ready, have your people ready, and rigs will hopefully become available in little windows between big jobs, and you've just got to snap them up and drill as quickly as you can. I think that's the solution.
Well, on the positive side, discoveries have been coming. I mean, that inflow of money into the sector, which has been, I guess, starved for exploration, we've been seeing some terrific discoveries in Australia and globally, and as a direct result of that, and that fires up investors and people looking at the sector.
Absolutely, I think that there's been discoveries in both traditional, if you like, areas, say like the WA goldfields, and not new but perhaps forgotten areas. And I put Julimar, Chalice's Julimar, in that zone. It was a known province, but Chalice really turned around. Same with Hemi. That people always knew that there was gold up there. But the convention was that there wasn't a lot of gold up there. And they drilled off 6-7 million ounces. So I think we're seeing discoveries flow both in the well-trodden areas and in the more forgotten areas, like Mount Isa. We just saw a great discovery up there. Well, extension of a known mineralization up there, copper project up there. So I think we're going to continue to see that, Richard, and hopefully Sensor will be be one of them delivering the goods.
Yeah, we're out drilling.
Can't discover anything if you're not drilling.
Sorry, I just want to make a note for our audience that are listening in that we are accepting questions through the Q&A box. So if you have any questions for our panelists as the discussion continues, definitely feel free to type those questions in. I wanted to ask, kind of following on from this, really kind of, you know, what are investors focused on right now? Where is the money going? What sort of criteria are being used to assess exploration ventures right now?
I think, you know, money's going, you know, in metals. Well, perhaps I could just take a little bit of a step back because we actually invest both in mining and oil and gas. And from that big perspective, money is definitely not going into fossil fuels in terms of exploration. And conversely, money is definitely going into hard rock mineral exploration. I think, you know, on the fossil fuel side, the discovery rate of a barrel of oil was the lowest it's been for 75 years last year. Even though, you know, that some of the best performing commodities of 2021 were the fossil fuels, coal, gas, and oil. So an interesting thing we've seen from that is a number of oil and gas companies are wanting to go green, and one of the ways of doing that is to look at you know, battery minerals and try and turn their expertise towards the more hard rock sector. So I think that's another source of funding. Not that the exploration sector particularly needs at the moment, but there's some funding coming from the oil and gas sector. But when you look at the metal sector, it's the traditional gold, which is still winning the lion's share of exploration attention and dollars, but also battery minerals is where it's, you know, where the you know, as everyone knows, that's definitely flavor of the month. And, you know, we saw lithium last year. Lithium carbonate price was up over 400% last year, and I think there's a little bit of catch up to do. A number of companies are dusting off their lithium credentials of in the prospectivity of their projects, and will be refocusing perhaps some of that gold exploration money towards lithium in particular.
It does appear that funding, particularly from the retail market, has gone from, say, 2015-16 being very little interest in that kind of thing. There was an enormous surge into gold exploration when the gold price spiked quite early in the intervening period since then. I think lithium, as John said, has been a massive flavour of the month for the retail market to focus on after that in two episodes. And here we are now in the latter of them, which is probably by far the biggest. The battery materials space has broadened quite significantly as well. So in 2016, if we were talking about battery materials, it was probably lithium, plus or minus cobalt and graphite. And now it seems to be everything, which is a base metal, and a number of other things as well. So, you know, that thematic, which is, I think, probably broader than just batteries. And John, when you talk about money coming from traditional fossil fuel producers into the kinds of things that they can diversify into, I mean, that also seems to capture hydrogen as well as quite a few of the harder rock mineral commodities. But when I look at where the interests are from some of the major companies, and that's the harder one to palpate, because they'll tell publicly where they're going and talk about how big their businesses are, but often don't talk in a lot of detail about what their exploration efforts are. I get the sense from, you know, business development inquiries and other kinds of conversations that you can sometimes pick up on. There's a lot of these companies which were very slow to the battery materials thematic, had embraced the fact that they have perhaps a large copper division, a little bit of nickel, but otherwise iron ore focused, and are now thinking, well, this is as real as it's going to get. That's not to say it hasn't been real till now, but are thinking about how they can, you know, add multiples to the supply of the metals which they do work in, which are battery materials, and make themselves look more green. So I think that's going to be a really interesting surge in investment over the next couple of years, because for those companies to make that decision, it's not just a $5 million funding program. It's all of a sudden, purchase of competitors or investment into wholesale greenfields, 100 rigs type exploration around the world, which can starve the juniors out, like John was saying, in terms of access to them, or Richard was saying. So I think there's another interesting thematic approaching us there. It's we'll have to watch for it to play out, but it feels like that's coming.
Just to add, I mean, one of the technical things and part of the R&D we've been doing recently, though, is that I guess nickel, lithium, and gold in Australia are particularly associated with the tenements. So you've had this massive gold boom, very hot exploration tenure, but you're seeing some of the best nickel, lithium prospects sitting on gold juniors or gold majors ground. And there hasn't been any incentive to be able to develop that aspect of the business until potentially recently. So based on our research, we're going to see some of the gold companies coming out, and we've seen in just recent weeks some interesting examples of that, looking at regassing old core for polymetallic base metals, because they hold some of the hottest prospects on the planet for some of these materials. And I think there is appetite in investors now to be able to see particularly battery minerals being added to a gold portfolio. But more importantly, there's a very strong technical case for the tenements that are being held by some of those juniors to host nickel and lithium deposits.
I'm curious about kind of the gold aspect of it. I know there's been, gold kind of fell off the radar a bit last year, kind of fell out of a lot of the discussions in terms of investment and prospects. Is there still kind of a future for pure gold, the gold markets, or is it more of this kind of cross multi-commodity sites that you see more of?
I think it reappeared 2 days ago, Amy, as something which the investment market is prepared to take an interest in, and that's always been a endearing feature of gold, at least from my point of view, is that it can get turned off in terms of how people feel about it, but it can reappear quite quickly. I think the phenomenon which we're seeing at the moment could be quite short-lived. It seems tied very much to some prospects of global conflict, but gold tends to find its own when large buckets of money which are invested in other things find a need to be able to put itself into a form of a store of value, if you like, for the future that isn't exposed to monetary inflation or the erosion of purchasing power. And we could very well be on the cusp of a fairly significant global economic event like that, if you look at the way that inflation and interest rates might go in the medium term. So I think it's hard to say that gold could lose its allure, but in the time between now and the last couple of massive gold bull markets where the same sorts of things played out, I think it's fair to say that there's been a greater diversity for people to take a piece of if they're after something which is a hedge against inflation, and their ability to invest in those things as well. So in 1980, if you wanted to invest in gold and you're an institution, it was almost impossible. There are ETFs that permit that now. And likewise, as a retail investor, you could go out and buy it, but you had to store it under your bed, unless you were quite wealthy and decided to pay for storage for, and make that work over large amounts of the metal. Now you can either store it under your bed, or you could probably put as smaller an amount as $500 into a gold ETF and go from there. So those things have become more accessible. And then there's of course the phenomenon of the various kinds of crypto, which I think certain of those have popped up as being an alternative inflation hedge to some people. And it's not to say that I believe that, but if enough people do, then that's where their money will go if they seek a hedge. And that might play out as to how the gold space is treated from that point of view.
Just a reminder to the audience, if you do have questions, definitely feel free to type them into the Q&A box.
There is a question there, Amy, and I think I saw someone just stick their hand up a moment ago. So Thomas is asking, when you say money is flowing into rare earth, what's your concrete example? I'm not sure who mentioned rare earths before. John, was that you?
If I did, I might have been a slip of the tongue. Certainly, there was one rare earth IPO last year, as I understand it, which was one of the best performing IPOs on the ASX last year. But yeah, it's still a very, very niche commodity. I don't know, there might be in total half a dozen or a dozen companies looking at rare earths at the moment. I don't know what you guys think.
In terms of a concrete example, I look at Round Top Mountain in the US. I mean, that's a stellar example of a project. I can't think of one domestically in Australia, but Round Top in Texas, I mean, they've done a fantastic job at looking at that. And they're really at the pointy end of interest in North America and the Biden administration in onshoring their critical minerals and rare earth supply chain. It's a pretty amazing project with very low costs of production when it comes into the market, but it's a really good example.
I think Thomas has a comment on that as well. It's a good one. I think in terms of money flowing into that space, if you just conceptualized $50 million in a year going into exploration in a metal space, that wouldn't be an enormous amount of money to flow into gold exploration. There'd already be multiples of that being invested on an annual basis. But I think for $50 million to flow into rare earth focused exploration, which is probably, that would be, say, 5 raisings by separate companies to do that. That would be a significant amount of money and make a difference into rare earth exploration. And I don't have the examples for it, but I've had a couple of term sheets over my desk in the last month or so for rare earth focused programs, and 2021 would have seen a large number of those, which struck me as being quite anomalous compared to the years, at least the couple of years leading up to that.
I like to make the contrast between rare earths and gold down the track in terms of developing a project. Certainly, I think a lot of money will always go into gold exploration, because ultimately, if you do find something as a junior, it is within the capacity of quite a few juniors to develop a gold project. Call 100,000 ounces a year, million tons per annum, whatever. It is within the financial and technical capacity of a junior to do that. Speaking generally. A rare earth project is very, very challenging from a metallurgical processing point of view, and can often be, as a result, the capex can often be significantly more substantial. So, while there obviously is a lot of government support for finding new sources of supply for rare earths, I think that challenge does make both investors and companies a little, maybe they have a second thought about moving into rare earth exploration.
I think as a glib answer, and Richard, you'll have a really on-the-job perspective on this, but most explorers would like to find something, irrespective of what commodity it is, because you generate value by doing that. And it's as you move down the path there that realization perhaps slips in that, gold is going to be something which could be monetized for a smaller amount of capex, perhaps in a scalable project. Copper is next easy in terms of separating and selling a product, and it gets harder and harder from there as you go up through sort of different commodities, and you find yourself in the bulks where it might be easier to find, but you need a train set and a port to be able to ultimately monetize those things. So I think it's a sliding realization, isn't it, that it doesn't put people off looking for them, but it can often result in the way that the market allocates funds to those things as well.
Yeah, although just to comment on that, Hedley, it's interesting, iron ore and coal prices have performed fantastically over the last 12 months, but we're just not seeing any money, much money devoted, certainly not to coal. No one's exploring for it. And iron ore, there's, compared to, say, the last boom in 2008, no one's exploring for that, 2 billion ton, 30% magnetite type project, as far as I'm aware.
Yeah.
I'd just say we're very, very bullish on gold. It's sort of for the same reasons that you're talking about. It's a great stepping stone for a company to be able to be working on it. I mean, just the juniors that I've worked with previously, gold has always been the route to growth. And they've started with gold and they've ended up with base metals. But it's very hard to jump straight and build an entire production team from the grassroots when you don't have that processing capacity in-house. So I think it's sort of something that it helps out the smaller end of town. But if you made a big base metals or rare earths discovery, you'd be looking pretty quickly for either a partner or a bigger group to be able to take on with that expertise to be able to extract the value from it. I don't think a junior would necessarily get paid for all of the value that could be created without being able to make the leap and work with big partners.
Mm. Gents and Amy, there's a question here from Greg Fowlis. How do you position your funds for the carbon zero structural theme versus a traditional cyclical view of commodities and resources? I.e., do you stay with stock picking and your track record and return capital, pay dividends, or do you start a new battery metals fund? There's probably a couple of questions within that, but Richard, perhaps one of the ways that you could look at this is it more lucrative to be looking for battery metal, battery material type things, or sticking to a more, I call it, traditional approach? Perhaps we touched on that already, and maybe John and I could come back to the division of capital towards one form or the other.
There's definitely a thematic in relation to, I guess, zero emissions that's running right through not only the big end of town, but also the junior space, in particularly nickel, lithium, copper. It's something that has driven a lot of the business strategies for the last 12 to 18 months. I think it's about being realistic about what you can and can't take on. As I talked with before, there is a really strong technical view that the tenements that are associated with gold, nickel, lithium, particularly in WA, have the potential to be able to carry both an interest in gold and also battery minerals. But it's looking about how you separate that out. I mean, our strategy in particular is to focus on our gold assets, but to unlock the value from nickel, copper, and lithium, and work with partners to be able to take forward not only the development of those projects, but also the exploration risk that's associated with it. I think you're seeing other companies adopt similar types of strategies by splitting out lithium commodity-specific aspects of their portfolio. But it's really about, and I think it'll really take a change in the investor approach to gold only or commodity focus to see that replicated more broadly within the industry. I think there's still a lot of desire to see focus and focus on a commodity, on a region, on a project from the junior end of town, but it'd be useful to know your positions on those.
John, do you see any inclination of capital to be on one side of the equation or another, particularly in the sort of future facing, to use as many catchphrases as I can, battery materials type things? I mean, I think you already got the ability to do anything in the mineral resource space in terms of oil, gas, mineral commodities. So, you might have touched on something there.
Yeah, look, definitely there's a push to, from investors. There's new funds being set up all the time. Well, that's what it felt like last year, with a focus on, green metals, if you like, and the clanks: copper, lithium, aluminium, nickel, and cobalt. I think that's what it stands for. So yeah, look, there's a big push, definitely from institutions to look at, moving towards a low carbon economy and supplying that. For us, we're still just one fund, and we put everything into the one basket. But yeah, we're definitely looking to try and increase our exposure to those battery metals, if you like, and include nickel and copper, or in that, the electrification theme. So that's definitely a push from our point of view.
I mean, it's interesting that there are periods of time where commodity thematics can have a bit of faddish feel to them. And in 2017, lithium was maybe not faddish, but certainly seemed like there was a really headlong dive all at once, which ultimately ran into lost a bit of steam. So I've often sensed this kind of hesitancy to be all in on any one thing, and at that stage, I didn't sense any sort of separation of the capital, but I do get the sense that there is more and more money which is trying to chase into that broad battery thematic specifically, and would be happy to leave behind, or at least take very little of some of the others along the way. So, Greg, I don't know if that answers your question. I hope it does. Can always take it up with you afterwards as well. Amy, there was a question that came through on the chat there about wanting to know about interest to invest in Africa. I don't know if it's the right thing for us to be doing, to be responding to specific queries about individuals' projects that they have in Africa, but we could probably structure a question there around the interest of exploration markets, investors, etc., into different jurisdictions. And
yeah, absolutely. I'd like to stay away from kind of specifically giving investment advice in terms of specific companies or anything, but certainly looking at investment opportunities outside of Australia is something that would definitely be relevant to this conversation.
John, do you want to lead off on that, and then Richard, some thoughts before I put my 2 cents in on it?
Yeah, look, just speaking personally, we definitely invest in Africa. We've got about 16% of our funds invested in African focused companies, and has been very successful for us. But Africa is a very big continent, and there are a lot of over 50 different countries there, all of which have their individual geopolitical, sovereign risks. So Africa just ain't one place. I would, on the stats, harking back to the Austex stats, there's of 300 odd gold companies on the gold focused companies on the ASX. I think there's 22 that are focused on Africa. So that's actually a fairly small number, relatively. And part of that, I think, is that there is, the African discount. If you apply that to an ounce in the ground, I reckon, I haven't got the quantitative analysis on it, but I reckon at the moment an ounce in the ground in Africa is trading at about half of what an ounce in the ground in Western Australia might trade at on an enterprise value per ounce. So that's probably the reason that you've probably got to find twice as many ounces in Africa to get the same value as in a place like Western Australia. But having said that, the opportunity and the amount of exploration historically that's been done in some of these more greenfields jurisdictions means that the opportunity is that much greater.
Richard, I think you're largely Australian focused, but perhaps you could just talk about your interest or willingness to go chasing giants in places like Asia or Africa or wherever else versus giants in Australia. I don't think there's any difference in prospectivity, but there's certainly a difference in the way that investors are willing to judge probabilities and also dish out money.
Yeah, I think there is a material, difference between the more, long-term mining jurisdictions. You could put Australia, South Africa, North America, and parts of Europe there together. Is that a lot of the easy discoveries or the superficial discoveries have been made sometimes a very long period ago. I think some of that opportunity still exists in Africa and Asia, where you're getting into countries where modern techniques have not been applied, and that's where the opportunities and the elephants exist. But for us, we think there's a hell of a lot more to be discovered in Australia, particularly in long-term mining jurisdictions in North America that we're focused on. And I think there's the technical successes of being able to use big data sets that we see will hopefully unlock areas that are previously been unable to be explored. So we're particularly focused on deep undercover search. So a lot of Australia is covered by sediments and sands, etc., that obscure the basement, and that's almost like going to another continent or another planet. We don't know enough about that. We need to find out more, and the place that you're most likely to discover a new mine is in a well-known mining jurisdiction just close to the head frame, usually.
Sorry, go on, Amy.
Yeah, Richard, I'm wondering if you can speak a bit more about kind of some of the technological aspects that you guys use, or new trends in technology to assist with this.
Yeah, a lot of this is coming from a big investment, a multi-decade investment by the governments in Australia and industry in collecting data. We think we look at the GSWA, the Geological Survey of Western Australia, has collected almost $25 billion worth of data that sits within its archives. This is just an amazing resource for artificial intelligence and machine learning to be able to crawl over and look for those patterns in the data. We're seeing a really, I guess, a renewed interest in how you apply AI into these sort of anomaly searches. So we're looking for an anomaly in the Earth's crust that hosts a major mine. I think Cobalt, which is sort of a North American competitor of ours, just raised 192 million as a private company backed by Bill Gates and Jeff Bezos to pursue this sort of approach, which is using all the data that's available, the geophysics, the geochemistry, geology, etc., to be able to find patterns in that data that reveal mines of the future. It's not about necessarily what we're doing as a company, but it's something that's being applied in all parts of the mining business. We're seeing AI running processing plants remotely, outperforming human operators in the mine plant area. We're seeing pit optimization and scenarios being run on supercomputers that are generating vast returns in product, being able to better model contaminants in different ore bodies and being able to minimize the impact on the environment. These are changes that are happening in the mining space, as well as there's going to flow over to the exploration space and in adjacent industries. So I think it's a pretty exciting time, not only for mining, but exploration, but also the companies that are innovative and the ones that want to do something different.
Interesting. So we've had a question come in from the audience asking about China. So noting that it is import dependent on iron ore, lithium, cobalt, nickel, copper, zinc, lead, aluminium, and so on. Have China investors played a role before, and do they play a role now? Hadley, maybe you want to kick us off.
Wow. Yeah, I think that's a really good question, because I mean, China sort of is an elephant in the room, whether you're talking about politics or freedom of speech or mineral commodity consumption or power stations in the backdrop of ski jumps. You know, it's central to so many topical conversations at the moment. The mineral commodity boom, which we saw from circa 2000 through to 2008, and then the same demand flowed right through to 2011, which was the last big peak, I think, in mining activity and mining valuations, was driven to a large extent by the emergence of China as a commodity purchaser. So there's undeniable interest and ability to move markets by the Chinese purchasing power, if you like. And it's remarkably different to the kind of interest that you see from just about any other nation in terms of their purchasing ability. It's remarkably collective in its ability to approach purchasing into one space. And iron ore is a great example. Iron ore is very concentrated in terms of supply, Australia and Brazil, and it's remarkably concentrated in terms of demand. So much of it goes to China. So they can move markets, will they? I suppose one of the topics that I think about is looking at where offtake agreements for things like these future-facing commodities are coming from, because in some minerals, China is a big consumer, but is also a big producer. And in others, it's a big consumer, but has next to no native production of its own. And I see Chinese entities taking offtakes in a lot of developing projects, which suggests that China could find itself in a position to speak for quite a bit of the production, if you like, of the downstream usable commodities that go into batteries and different forms of electricity storage and generation. So I think there's an interesting topic there. It's a difficult one to speak to with a great deal of authority, because I think you also need to contrast that against the way that the rest of the world feels about China. And at the moment, that political I suppose perception is moving very, very quickly. So, it's opportunity, it's threat, and it's a risk, whichever way you look at it. And I think we need to see where that plays out. Now, I think your question was around, is there money behind that? And there's undoubted money behind it. There's an awful lot of money which could flow out of China for investment in these things. And I think their character as investors has changed very much over time. It used to be that there was no sense of NPV. It was all about strategic putting a foot on, and an awful lot of money was spent on getting a foot onto deposits in terms of control or offtake or speaking for it. I think it's much more concerned now with making sensible decisions, and some of those go a long way up the tree before the money comes back down. So I'm sure these other gents will have a bit to say about that as well, though.
I'll jump in, John. I think one of the good things that has happened recently has been a renewed interest in other economies in investing in some of the processing and downstream production that's required to be able to develop an industry around those areas, rare earths, a renewed interest in base metal production and processing domestically. I think that's a positive. I think it's also a positive that we remain open to making sure that countries have access to the supplies that are needed to be able to develop their economies. And going too far either direction creates, I guess, broader problems within the sector. So it does sound a bit trite, but I think balance is key here, and it's on both of the supply and demand side. We need renewed investment in certain countries in making sure that there is strong domestic capability in these areas, but we also need to make sure that we do not block countries from securing those the assets that they need to be able to run their own domestic economies. So I think companies in the exploration and the mining space can benefit from what is a need for both continued supply for countries, but also renewed investment in certain countries that may have not put the same attention on those commodities in the last 20 or 30 years.
Anecdotally, what I've seen in the last few years is actually some Chinese companies exiting mineral projects in Australia. And they may have been projects that were acquired or interests that were acquired, during the last mining boom 10 or 15 years ago. And then, for whatever reason, and it may well be controls on getting money out of China, those projects haven't been able to be progressed by those Chinese companies. And also, might be that there are FIRB exchange restrictions more tightly imposed on Chinese money coming into Australia. So, I have seen a number of projects being sold by Chinese companies in Australia to, ASX listed or Australian companies. So I think actually, after a massive inflow of funds into the mineral sector or the more early stage exploration sector during the last mining boom, we're actually possibly seeing some funds flowing the other way.
We're getting kind of close to the hour mark. So I had one kind of final question for our panelists. Looking at kind of these supply chains, supply demand trends, and the idea of having kind of regional or domestic supply. Is this kind of the big push that we're seeing right now with this exploration boom in Australia to kind of secure more domestic supply for Australia? And do you see this as kind of the way forward, or do you see more kind of international supply chains restarting?
I think when it comes to exploration, it is such a disparate source of funding and so far from the end use in a lot of cases that the people who provide the money are very, very rarely motivated by some sort of parochial intent as to where it will be used or how it will be used. I think there's a point to be made around how Australia could be very much on the forefront of modern high-tech manufacturing and probably has everything it needs from a starting basis to be a leader in green energies and even battery manufacturing and things like that. But that's sort of more of I think a government position to motivate investors to put the money into the downstream, and then for the investors to do that, because their money will flow to where they see the opportunities are going to be, best positioned, safe, low cost jurisdictions and things like that. And There's a few structural blockages there. Whereas finding those things in Australia, irrespective of where they're going to be sold, is a geological proposition, and it's driven by being a low-cost jurisdiction as well, which positions it quite highly to be the source, but not necessarily linked to the downstream. So I don't think there's too many investors that invest in Australian exploration who think this will lead to Australia being self-sufficient in something down the track.
Yeah, it's one of the ironies of the exploration finance sector is that money flows in when a particular metal price is high, but it's a hell of a long time between putting the first drill hole into a prospect and actually getting commercial metal out. I think the point where you are seeing money flowing as a result of concern about supply chains, and Richard alluded to this earlier, is when there's a defined resource and a project is well on the way into feasibility, and the investors can see that there's a much higher likelihood of a project being developed and the particular commodity that they're after being produced. And rare earths is a good example of that. I think there's certainly money from the US coming or potentially available to Australia to advance known resources. But I think if you just put your hand out and said, I've got an idea for a prospect in the back blocks, I think you're going to struggle on that basis.
It's possible that thematic actually works in reverse too, Amy, because if you were just to talk about, do investors want to invest in rare earths or copper in order to see native production in Australia or even self-sufficiency in it? I'd say no, there's no connection. But if you would ask the question, are Australian investors willing to cut off the supply of exploration funds to coal companies to try and stymie the future ability to produce that? That's definitely a thematic, which John mentioned earlier. So probably if you just flip the question, there's an answer there of more connection.
The only thing I'd add is I think it's a little bit about risk. So I think the signals that government have made about critical minerals and battery minerals and putting money into the critical minerals manufacturing plan, it does sort of signal that governments will support projects in these areas, and they will get permitted and they will get support, and that lowers the risk for investors in potentially going into those sectors and those projects. So I think it's a positive signal, but I don't think investors are making too many decisions on exploration at the moment with that front of mind.
Amy, there's one question I think in the Q&A which we could possibly get to before we go. How do you see the opportunity for uranium exploration financing in Australia? Should we deal with that and then wrap it up?
Yeah, sounds good.
So I think that's another good question. Uranium is something which pops up roughly every 8 or 10 years as the price increases, and it's usually forecast for the 5 years in the lead up to it, and then in the few years on the other side of the peak, it's usually sort of clung to. It's not to say that it's a poor place to put your money. You just need to understand the risks there. And I think uranium is something which in 2006-07, I think we showed that it's reasonably easy to find. There are lots and lots of paleo channels with uranium in them. The concept of pushing a project forward is that for every 10 gold deposits you find, you might be able to develop 7, something like that. For every 10 uranium deposits you find, it might be less than 1, which is of the size and metallurgical characteristics which suit development and pushing into production. So I think we touched on those kinds of downstreaming risks on a number of commodities before, but didn't mention uranium specifically. And that definitely affects the interest in exploration. But then you have these moments like we're going through now where the uranium price starts to move, and the equities, particularly of a lot of the juniors that hold projects, start to move as well. And that produces, I think, a narrow window in which uranium financing for exploration is highly possible. It just leads to some fairly uncertain outcomes as to whether or not those projects will go further. So trading opportunities in some cases, and you can't say they won't be developed, but potentially there's that risk that it's something which is a much slower burn in terms of coming to the realization of a cash producing value.
I think uranium companies, and there's not that many of them, still standing after being beaten up since Fukushima. They are well funded. There was, with the Sprott Fund pushing the price up, $20 a pound last year. There was a lot of renewed interest in uranium, and I think there still is. And so some of these junior companies are now, had a meeting last week with one of them who are very well funded, and they said, look, we're working on projects that we knew about, last time around in the last uranium boom, but we're also going to dedicate some funding to try and find completely new deposits in new provinces. Something like that, if they were successful, could set the sector alight. But I think at the moment, Hedley, you sort of alluded to the fact that we think these companies are pretty well valued at the moment, given say the uranium price is $45 a pound, and they may generally be sitting on a project which might need $60 a pound to incentivize its development. So there's a probably, the market is probably expecting that the uranium price is going to go significantly higher, whereas the equities have already priced that in.
I don't think I can. I'll defer to John and Hedley on that one. It's not a market that I'm following that closely.
No worries. You know what, that really does bring us to the hour. I think everyone's there's been some really interesting points about the exploration market in Australia and things to kind of be looking out for. So I'd like to thank all of our panelists for taking part today. And we will be posting this session up on our sites within the next day or two. So if anyone wants to have another listen through, we will be sending that link out shortly. So thanks everyone for taking part, and we'll see you at one of our events, either online or in person sometime soon. So thank you.
Thank you, Amy, and
Thanks,
thank you,
Amy.
John and Richard as well. It's been terrific.